China's trade surplus halved last month as imports surged. The figures helped lift metals and grains prices overnight, boosted by optimism about Chinese demand. Cotton too is booming, with prices at record highs of above $1.90 a pound. To discuss this and other developments in commodities markets, I spoke earlier to Jonathan Barrett, the Managing Director of Commodity Broking Services. Jonathan, thanks for joining Business Today. So cotton, why is it so high? Is it because of the global shortage?
So it's quite interesting. There has been a few developments in the copper market. I guess the most important thing is India. India is the number 2 producer. They're also the number 2 exporter, and India has actually come back from the market and said that they're not going to export. So that in itself has created an additional shortage, which has seen prices just go through the roof.
So is there a risk that other countries will do the same?
I think we are seeing it. India did it with sugar, where they had concerns at home, so they decided not to export. And this is where more governments are getting involved in the sovereign risk of what they produce. So I think this is a trend which is going to extend, I think, as we get more concerns on weather and production.
Now, a note from Rabobank says that the world needs a record cotton crop this year just to maintain supply. So given all the bad weather events we've seen, is that achievable?
That's going to be the tough one. We don't really know what's happening with the weather side of it. We've still got major weather concerns. I mean, Australia lost about 6 to 8% of its production. So I think it is an issue that we're just going to have to work with. But yes, it's a real concern. We do have a lot of buyers, and everyone needs an extra shirt or an extra pair of socks or something. So I think we're going to see that market develop into a structural deficit.
So those higher prices, are they translating into better prices for farmers?
Well, that's the interesting thing. Because we've had such a large jump, farmers used to get in Australia about $600 a bale. Now they can get up to $1,000. So they're really left on the table a good 30% of profits. But in anyone's language, to a farmer that hasn't pre-sold, right, 600 is a very good level. And if they can get 1,000, it's even better.
Well, what about for consumers? Are we going to see, we're used to having cheap cotton clothes from India and Pakistan and China. Will that be different in the future? I
think we've got to look at substitutes. If the prices remain where they are, you'll look at the polyester side of things. And I think those substitutes will become more apparent, particularly as the prices stay at this level. So I think the days of having cotton shirts, now we'll have cotton with a little bit of mix of rayon in it or something. So I think there's a definite swing to other light goods.
We're seeing the cost of living rising across Asia, particularly in terms of food inflation, wheat prices that are at a 2.5-year high. So is that set to continue?
Look, it does feel as if there is this feeling. Obviously in China, I think, is one of the biggest concerns we have there, particularly for the wheat crop, or the winter wheat crop, because they haven't got enough subsoil moisture to actually put in a decent harvest. And we feel about 2/3 of the crop in China will be affected, pretty much because of the drought that's been there for 7 years. So I feel that this sort of supply-driven inflation, I think, will be with us. And I think some of the grains, particularly wheat and corn and also soya, will remain relatively well bid and probably even continue to trade higher.
So really consumers will have to adjust, or maybe governments will have to think about increasing food subsidies?
These things are going to have to do either that, or we're just going to have to eat a lot less, which probably isn't a bad thing.
Now, if we turn to hard commodities, copper again, we've seen it above $10,000 a tonne. So is it mainly China driving that demand?
It is. I mean, China is obviously the number 1 consumer. And what we're predicting is that deficit, that supply deficit, will continue. At the moment, it's marked around about 385,000 tonnes just for the 2011. Now, if China continues to do what it's doing, then that deficit will remain there and the price will remain relatively well bid. Copper in itself so far hasn't reached a high. It still looks bid, and we'll probably expect that to extend further into Q1, Q2.
And again, iron ore very much being driven by demand from China. Prices to China at around $220 a tonne. So how far will iron ore go? I think iron ore will continue. It's not just but what we're seeing in the iron ore space, there are more people coming into it. So as a result of that, I feel that we will get to a high where supply will equal demand and prices will level off. I don't see going
forward that prices can continue to soar, but I can see prices continuing to stabilise as more supply comes onto the market.
And that move to quarterly pricing from annual pricing, that's made a big difference, it seems.
Yeah, it has, and I think that will continue because people will be able to adjust pricing, adjust hedging, adjust what they need to produce as well, so to allow that price to remain relatively stable and not affect economies. Like with anything, primary import prices go through the roof. That'll affect economies' ability to have substantial growth.
And if we look just quickly at coal, of course we've seen huge increase in coking coal because of the floods in Queensland. Is that starting to come off a bit now?
Slowly, but only slowly. But what you are seeing is that still concern with the floods, and it takes a long time for pits to get rid of the excess water that they've got, and that will remain an issue, I think, for a couple of weeks or maybe another month. But once that starts to, we start to get good production again from those areas, and that price will come down. But at the moment, it still remains relatively well bid.
Of course, the perennial question facing Australia is its demand, its reliance on resources. Is Australia possibly making itself too vulnerable if the commodities boom goes bust again?
Well, I think that's one of the big issues. Yes, we are reliant. We are a resource-based economy. So if anything does occur in anywhere in China, if the cracks start to get a little bit wider, then that will definitely affect us. So I certainly feel that at this stage we are reliant on what's happening, and I think the government perhaps has to be a little bit more proactive, as in a sovereign basis, to be able to hedge against these concerns. If China starts to crack, we're going to start to crack.
Because, of course, the Reserve Bank of Australia, Glenn Stevens, has suggested there should be a sovereign wealth fund to cash in on the commodities boom. So would that make sense?
Absolutely, 100%, because those sorts of funds are there designed to help smooth what's actually happening there in the resource sector. What happens in India, what happens in China, shouldn't really affect what happens in Australia. But because we are so linked to it, it is a concern, and we should have something there.
There's also too much of a focus on resources. Australia's manufacturing, construction services industry are slumping because of the high Australian dollar and higher interest rates. So is that something that Australia has to look at long term?
I think they certainly do. I mean, when you look at the manufacturing sector, it's certainly not there. If you look at where our exports are and sort of what concern we've got with the Australian dollar, I think there has to be a slight different style of management within the economy to provide us more subsidies to allow our exports and our manufacturing, our domestic manufacturing to grow, and that's what we're not seeing at the moment.
Okay, Jonathan Barrett from Commodity Broking Services, thank you for joining us.
Thanks, Lee.